So in this problem, we have a company which is attempting to evaluate the profitability of adding another integrated circuit production line to its present operations. So the company is considering to add a new production line, a new asset. Okay, the company naturally wants to know if this is a good decision or not. So to calculate to evaluate this decision, you need to set this diagram, the cash flow diagram first, and then you want to convert every cash flow to the present worth, and then to see if the present worth is over or equal to 0, right? If yes, then it's a good decision. If no, then it's a bad one. But since we have learned the depreciation deduction, the taxable income, we need to consider the real cash flow, which is after tax cash flow. Okay, so what is given in this problem statement is before tax cash flows. You need to calculate the depreciation deduction and use the table we have learned, this one, to get the last column. That is your final cash flows. And then you use this cash flow to set up a cash flow diagram and then convert all the cash flows to the present worth. Okay, so the first thing is you need to translate the information into the table and fill up the table first. All right, let's see. So the company would need to purchase 2 or more acres of land. So a piece of land, it costs money, okay? The facility, it costs money too. It costs 60 million. And that facility is the net market value at the end of the 5 years, it's 0. So MV5 of the facility is 0, okay? And this first MV is MV of the land. And remember that land is not depreciated. It's not depreciable, okay? So that you need to keep that in mind. And an increment of working capital, you need to hire people, right, would be required as well. And its estimated amount is 10 million. So the MV of workforce is 10 million, and it's not depreciable as well, okay? And so gross income is expected to increase by 30 million per year. So that is your income, positive, for 5 years. And operating expenses are estimated to be 8 million per year for 5 years. So this is your positive income, this is your negative cash flow. So your net cash flow every year is gonna be your positive 30 million minus 8 million, okay? Like income minus your expenses. That's your net cash flow. So, and the firm's effective income tax rate is 40%. So that is the T. So first thing, you need to set up the table and determine the after-tax cash flow of this project. And then you use the present worth method to calculate if it's a good idea or not. So you're gonna use this because it's told that the facility is gonna be depreciated under the GDS recovery period of 5 years. So this is the column you're going to use to get the R's, okay? So this is your R1, R2, R3, R4, R5. Remember that it is said the MV of this asset is going to be 0 at the end of the 5 years, which means it's disposed of at the end of the 5 years. So you're not going to use the R6 because the market value is decreased to 0 already in the 5th year. Okay, that's why in this table you're going to have 0, year 0, year 1, year 2, year 5. Okay, so you're gonna have this table, but how do you get those numbers? First, the number of years, it's easy because it's a 5-year project. So you have 0, 1, 2, 3, 4, 5. That's the number of years. And also you have another 5 in the end because you're gonna talk about the market value, okay? And then in the first column, we said the first part in year 0, you have 3 costs: the facility, the piece of land, and the workforce. And they are all costs, so they are negative, right? And then for every year, you're gonna have a net cash flow, which is positive because you have 30 million as your income, you have 8 million as your expense. 30 minus 8 is positive 22 million, okay? And in the end, in the 5th year, you also have some market value left. Although your facility market value is 0, but you still have the land and you still have the workforce. They keep their value. So that's the total market value of the whole project left in the end of the 5th year. Okay. So this is for the workforce. It's not depreciable, so the value is still that. And this is the land. And actually you have a 0, that is the facility. Okay, so that's why you have this MV as 10,275,000. Okay, and then the column B is the DK. Okay, so 0 year, year 0, the DK is not available, so you can keep it empty. And starting from year 1, you're gonna have D1, D2, D3, D4, and D5. Okay, so how do you calculate? You use B times R1, B times R2, and so on. Okay, so let's say B times R1, that is your D1, and that is B is because only the facility is depreciable. Land and workforce are not. So your B here, you only talk about the facility. Okay, so the B of the facility is what? 60 million times R1. Okay, go back to this table. What is R1? R1 is under the 5-year GDS system, it's 0.2. Okay, so it's 0.2. So you're gonna have the DK is 12 million. And the D2 is B times R2. Okay, so it's 6 million times R2 is 0.32. 0.32. Okay, so if you calculate, it's 19,200,000. And D3 is B times R3, which is 6 million times R3. If you go back to check the table, R3 is gonna be 0.192. So that will give you 11,520,000. And the D4 is B times R4. B is 60,000. R4 is what? R4, if you go back to check the table, it is 0.1152. So you're gonna have 6,912,000. So now, what is D5? D5 is B times R5. Remember, the facility, it's gonna be disposed of at the end of the 5th year, and you know the MV is 0, okay? So you only can take a half-year depreciation for the 5-year. So you need to give it a half. So the B is 60 million. R5, if you check the table, it's 1152, and you need to half it. So the answer is 3,456,000. So that is the depreciation deduction in year 5, and this one is a little bit tricky. Okay, and then you have this B column filled up, and column C, that's the value of A minus B. Okay, so we have talked about this 10 million. It is the value of that row in column A, which is 22 million, minus that value in column B, the same row in column B, which is 12 million. Okay, and then you can also calculate the second one. Why do you have 2,800,000? That is 22 million minus 19,200,000. Okay, then you can get 2,800,000. So you just use the values in this row to calculate what is the value in the column C. Okay, and one thing to talk about is this last row. Why do you have this number? So this last row, if you take a look at this table, it's MV minus BV. Okay, and for this problem, the BV is BV5, right? Because you only have 5-year project, and this BV5 is the BV of the equipment. Okay, and then what is the MV? Is the MV this one? No, because the MV is only the asset which is depreciable. Okay, that is the MV of the facility, which is 0. Okay, so which means this cell is gonna be 0 minus BV5, and BV5 is what? BV5 is B minus D1, D2, D3, D4, and D5, which means it's the B minus the sum of this whole column. Okay, so let's see, it's 0 minus BV5, which is 0 minus D1, D2, D3, D4, D5. Okay, you already have this here. So the answer, if you calculate that, it's gonna be negative 6,912,000. That's how you have this number in this cell. Okay, and then it's to fill up the column D, it's easier. But don't forget about the negative sign, and then you need to time the numbers in column C by 40%. Okay, so the negative 4 million is gonna be 10 million times 0.4, and you need to add this negative sign. Okay, and so on. And this last one is the negative 6,912 times 0.4, but you need to give it a negative sign. So negative times negative is positive. Okay, so that's how you get this column for D. And then in column E, you're gonna just add the numbers in column A to the numbers in column D. Okay, and for the first cell, you just copy the capital investment from the before tax cash flow. But after that, you need to use whatever in the column A. So let's just write it here. Why do you have 18 million? That's because you need to have 22 million plus whatever you have in column D, because number in column D is negative, so it's a negative sign here, and then it's 4 million. So the answer is 18 million, and so on. Okay, and then talking about the last cell, it is the number in the column A, which is 10,275,000 plus the number in column D, which is 2,764,800. Okay, that will give you the 13,039,800. That's how you get this. Okay, so this problem, the tricky part is the last row, and you need to understand the facility is the only thing that is depreciable. The land and the workforce are not, and that is why here you got this number. Okay, this is the tricky part. All right, so and also don't forget about the negative sign here. Okay,